Welcome to this deep dive, tailored just for you, the learner.
Hey there.
You shared Peter Lynch's One Up on Wall Street with us. And our mission today is really to pull out the most valuable insights.
Yeah, make it practical.
Exactly. Help you become a more informed investor, but, without feeling totally overwhelmed by all the jargon. We're going to explore everything from why Lynch thinks individual investors like you actually have a real edge,
Which is a great starting point.
to how to spot promising companies, and, crucially, when to maybe think about selling.
Okay.
So let's just dive right in. Where does Lynch think someone like, well, the learner actually has an advantage in the stock market?
Well, what's really fascinating here, the learner, is Lynch's strong belief that you, just going about your daily life, often stumble upon fantastic investment opportunities long before the big Wall Street firms even notice.
So like years before.
Yeah, potentially. Think of it this way. Wall Street analysts, they see the financial blueprints, right? But you might be the one using the building every single day. And both viewpoints, well, they reveal critical truths about a company's value.
That's a brilliant way to put it. It really shifts how you think about your own experiences. He uses some pretty compelling examples of this, doesn't he? Like the gap.
Oh, absolutely. He tells this story. If in 1976 you'd spent, say, $180 on 10 pairs of jeans at the Gap,
Right.
those jeans would be long gone now, obviously.
Definitely.
But if you'd invested that same $180 in 10 shares of Gap stock back then, well, just 11 years later, it would have grown to like $4,672.
Oh, that really drives the point home, the power of just noticing something popular.
Spot on.
And didn't he also mention La Quinta Motor Inns, recognizing their success from his own travels?
Exactly. He talks about staying, I think it was 31 nights at La Quinta back in 73.
Okay.
And he put an equal amount into their stock. Within a decade, that investment had multiplied tenfold.
Incredible. So your everyday interactions, they can be really valuable early signals.
They absolutely can.
So it's like having this unique perspective, seeing things firsthand. Now, he also mentions this double edge of knowledge. Let's unpack that a bit. What's a nuance there?
Right, the double edge. It refers to those two different but, equally important types of understanding we just touched on.
Good.
You've got the professional investors, right?
Sure.
They have deep industry knowledge. They're poring over financial reports, analyzing competitors.
Spreadsheet guys.
Kinda, yeah. But then you, as a consumer, you have firsthand experience with the products, the services.
Right.
You know what works, what's popular, what people genuinely seem to like. And Lynch argues both kinds of insight are really valuable tools for picking stocks.
That's really insightful. Makes investing feel less like some secret club and more connected to just, well, living life. And Lynch also champions looking at companies that might not be, let's say, the most exciting on the surface, right? He talks about dull names, boring businesses.
Yes. He's a huge advocate for the unglamorous. He points out that companies with less flashy names and businesses, like Crown Cork and Seal,
What are they?
they make cans and bottle caps. Pretty boring, right?
Uh-huh.
Or Agency Rent-A-Car. These often fly completely under the radar of the hype-driven market crowd.
So they get ignored.
Often, yeah. And this lack of widespread attention can create real opportunities for early investors well before the broader market finally catches on to their potential.
So while everyone else is chasing the latest tech buzzword, there could be solid value in the companies making, I don't know, cardboard boxes or something.
Precisely. Or bottle caps. It's tied to that idea of focusing on what you actually know and understand. One in the hand is worth 10 in the bush.
Right, stick to your knitting, sort of.
Exactly. Don't feel pressured to jump into every trendy stock or some complex tech you don't really get. Stick to what's familiar, the businesses you encounter. That's where your personal insights can give you that edge.
Okay, that makes a lot of sense. So individuals have these potential advantages. But before we even think about buying a single share, what groundwork does Lynch say we need to lay? What's the personal preparation involved?
Right. Before even looking at stocks, Lynch really hammers home the importance of getting your own financial house in order first.
Okay, fundamentals.
Absolutely. And interestingly, this starts, in his view, with owning a home.
Owning a house. Before stocks. Why?
Well, he sees homeownership as a more stable, kind of long-term asset base before you venture into the potentially more volatile stock market.
Huh. Interesting. Why is owning a house such a key first step for him?
He gives a few reasons. One, it's typically a very long-term investment, right?
Yeah.
Also, the way it's usually financed can have tax advantages. But maybe the most crucial point is psychological.
How so?
He suggests you're far less likely to make impulsive, panicky decisions about selling your house based on, scary news headlines.
Right, you don't see a daily price ticker for your living room.
Exactly. Unlike with stocks, where the price is constantly flashing at you, there's an inherent stability there.
That's a really smart point, that emotional stability. Okay, what else is crucial preparation?
Secondly, Lynch stresses understanding your time horizon. You have to be really honest with yourself. Will you need the money you're investing in the near future?
Like next year?
Yeah, say within the next year or two for something major like college tuition or a down payment. If you do, the stock market, with its potential for short-term swings,
Up and down.
it might not be the right place for that specific money. You don't want to be forced to sell at a bad time.
That sounds basic, but it's such a vital reminder. Only invest money you won't need immediately. And then there are the personal qualities he talks about, right? The mindset.
Yes. The third critical piece is having the right personal temperament. Lynch lists qualities like patience,
Definitely need that.
self-reliance, just good old common sense, the ability to handle market downturns without hitting the panic button.
Easier said than done sometimes.
Oh, for sure. But also having an open mind to new information and, crucially, the ability to just ignore the widespread fear-mongering you sometimes hear. He really believes these psychological traits are just as important, maybe even more so than any fancy financial analysis skills.
It's about having that mental fortitude, that discipline to stick with your plan, even when the market's going crazy. He even mentions IQ, which I found kind of surprising.
Yeah, that's intriguing, isn't it? His observation is that the most successful investors often land somewhere in the middle of the IQ range.
Not the super geniuses.
Not necessarily. His thinking is that extremely high IQ individuals can sometimes overcomplicate things,
Right.
get lost in complex theories,
Right.
whereas successful investing often requires a more practical, common sense approach. Gut feel, almost.
So being too smart could actually be a disadvantage here. That's a really counterintuitive perspective.
It is.
And what's the sort of fundamental rule he emphasizes before you even pick a single stock? The absolute baseline.
The core principle is, well, it's simple but absolutely essential. Only invest what you can truly afford to lose without it negatively impacting your daily life, your standard of living.
Right. Don't invest the rent money.
Exactly. It provides that crucial safety net and helps prevent those emotionally charged decisions driven by fear of, financial ruin.
Okay. Makes sense.
Yeah.
So we've got our personal finances sorted. We've got the right mindset, hopefully. Now we turn to the market itself. But Lynch has a pretty unique take here, doesn't he? He talks about the market's irrelevance, at least in the short term.
This is absolutely a cornerstone of his whole investment philosophy. He famously quotes Warren Buffett,
The oracle.
who said something like, "As far as I'm concerned, the stock market doesn't exist. It is there only as a reference to see if anybody is offering to do anything foolish."
Okay.
Lynch's point is your main focus should be on the individual companies you invest in, not on trying to predict which way the overall market is going to swing tomorrow or next week.
So all that effort people put into timing the market, forecasting the S&P 500's next move, it's basically wasted energy.
In his view, yeah, largely futile. He gives this great example from the steel industry back in the 1980s.
Okay.
Even if you correctly predicted a recovery in steel, right? If you just picked any steel stock randomly, you might have ended up with LTV,
Which went?
bankrupt. While another steel maker, Nucor, absolutely thrived during that same period.
Wow.
So predicting the bigger market trend wasn't enough. You had to pick the right company within that trend.
That's a powerful illustration. Company analysis is key. And he also touches on the psychology of market predictions, right?
He does. He observes that, negative or bearish arguments about the market, they often sound more sophisticated, more intelligent.
Yeah, doom and gloom always sounds smarter somehow.
It does, and it can understandably make investors really nervous, but the historical data clearly shows the market has generally rewarded long-term investors, people who just stay invested through the crashes, the recessions. He mentions several past periods of, exaggerated fear, the supposed Great Depression of 1990, or the Y2K bug panic.
Oh, I remember Y2K.
Right. None of which ultimately derailed the market's long-term upward trend.
So resisting that urge to panic sell based on scary headlines is just crucial for long-term success. And simply staying invested, being patient over the long haul, that makes a huge difference in returns, doesn't it?
Oh, absolutely. Lynch provides this really compelling example. If you had invested, say, $100,000
Okay.
and you missed just the 5 best performing months in the stock market over a 25-year period, your overall returns could be drastically lower, like significantly lower.
Just 5 months out of
It's
300.
just 5. So remaining invested through the good times and the bad dramatically increases your potential for those substantial long-term rewards. Time in the market, not timing the market.
Okay, got it. So we're not trying to be market gurus. We're focusing on finding good companies. Now, the exciting part,
Right.
how does Lynch suggest we actually identify these winning stocks? Where do we even start looking?
Lynch points to several promising places to hunt for good investments. One key area is focusing on companies that show really consistent earnings growth over time.
Steady eddies?
Sort of, yeah, like automatic data processing, ADP. He mentions their earnings increased every single year since they went public way back in 1961.
Wow, that's consistency.
Right. He emphasizes that fundamental principle. In the long run, a company's stock price tends to follow its earnings, up or down.
Makes sense. Reliable performance.
Yeah.
He also mentions, and it seems obvious but maybe worth saying,
Huh.
don't invest in stuff you know absolutely nothing about.
Yes. It is common sense, but easily forgotten. He uses this funny analogy of a marathon runner trying to compete in a bobsled race.
Huh, yeah.
Stick to industries and companies where you have some level of understanding, whether it's from your job or just, being a consumer.
Got it. What about spin-offs? He seems quite bullish on those.
Lynch is a big fan of investing in spin-offs. His argument is that the parent company typically really wants its newly separated division to succeed.
Okay, so they set it up for success.
Often, yes. They tend to give these spin-off companies strong balance sheets, motivated management teams focused on cutting costs, improving profits. The classic example is the Baby Bell companies created from the AT&T breakup.
Ah, right. They did pretty well.
Hugely successful spin-offs, many of them.
That's an interesting angle, the parent's vested interest. He also suggests looking at stocks that the pros, the Wall Street types, have kind of given up on.
Yeah, he recommends exploring stocks that have been largely abandoned by institutional investors. These can sometimes present really significant turnaround opportunities.
Like finding diamonds in the rough.
Exactly. He cites Chrysler and Exxon as examples of companies that were once really out of favor but later staged massive recoveries. He even gives resources for finding data on who owns what stock, like Vickers or Value Line.
So sometimes going against the herd, looking where others aren't, can pay off. And then he talks about asset plays, companies where the value of their stuff, their assets, is greater than their stock price implies. Sounds like finding hidden treasure.
That's a good way to think about it. Asset plays are another area Lynch highlights. These are companies where the intrinsic value of their tangible assets, like maybe they own a ton of valuable real estate or have really valuable subsidiaries, that value exceeds their market capitalization, which is basically the total stock market value of the company.
Gotcha.
He gives examples like Penn Central, which owned a lot of land, or Liberty Corp with media properties. Their parts were worth more than the whole, essentially. He also points to UAL, United Airlines' parent, and Del Hayes, a food retailer, as cases where investing in the parent basically got you valuable subsidiaries almost for free because the market wasn't pricing them in properly.
It's like uncovering hidden value the market just hasn't spotted yet. And then he breaks down stocks into different categories, which I think is really useful for understanding what you're buying.
He does. He categorizes stocks into, first, slow growers. These are often big, mature companies, maybe paying regular dividends.
Okay.
Like utilities, maybe? Could be, yeah. Then stalwarts companies with steady, reliable growth, but not explosive. Think Procter & Gamble.
Right. Dependable.
Then fast growers, these are the exciting ones, companies experiencing rapid earnings growth.
High potential, maybe higher risk.
Often, yeah. Then cyclicals, their performance is really tied to the overall economy. Think auto companies or construction.
Up when the economy's good, down when it's bad.
Exactly. And finally, turnarounds companies recovering from some kind of trouble. Understanding which bucket a stock falls into helps you set realistic expectations for how it might perform.
So you wouldn't expect, like, 50% annual growth from a slow grower.
Probably not, no.
And he also cautions against too much diversification. That's another point that might surprise people. We always hear, diversify, diversify.
Lynch argues it's actually more effective to thoroughly research and really understand a smaller number of high-quality stocks than it is to just spread your money thinly across a huge number of companies you barely know anything about. His focus is on the quality of each individual investment, not just hitting some arbitrary number of holdings.
Quality over quantity,
Mhm.
based on deep understanding. Makes perfect sense. Okay, so we have some ideas on where to look. Now, what specific characteristics within a company make it attractive in Lynch's view? What are the green lights?
Lynch identifies several key traits. One big one is operating in some kind of niche market,
A niche, like what?
something that gives it protection from intense competition. He uses Warren Buffett's early investments as examples, or affiliated publications, which published the Boston Globe. They dominated their local market.
Okay.
He also uses the aggregate business,
Yeah.
rock, sand, gravel as an example,
Rocks and sand. How's that a niche?
because it's incredibly expensive to transport that stuff. So a local quarry has a natural barrier against faraway competitors. It creates a sort of local monopoly.
Ah, high barriers to entry due to costs. Got it. What else does he look for?
He also likes companies with products or services that generate repeat business. Customers coming back again and again. That creates a much more predictable revenue stream.
Makes sense. Loyalty.
And related to that, he likes companies whose products are still needed even during a recession. Essential goods and services tend to hold up better when times get tough.
Right. People still need to eat, use electricity. What about insights from inside the company, like management?
Insider buying is a very positive sign for Lynch. That's when the company's own executives, directors, buy shares of their own company's stock on the open market.
Why is that so positive?
He believes insiders generally buy for only one reason. They think the stock price is going to go up.
Right.
Insider selling, on the other hand, can happen for lots of reasons. Diversification, buying a house, whatever, so it's not always a negative signal.
Got it. Buy is good, sell is maybe okay.
Another positive sign is when the company itself buys back its own shares. That suggests management believes the stock is currently undervalued by the market.
So when the people running the show put their own money in, when the company uses its cash to buy its own stock.
Yeah.
Good signs. He also mentioned that a lack of attention from Wall Street can sometimes be good. How does that work?
Yeah, Lynch suggests that if analysts aren't covering a company, or if there are even negative rumors floating around, that can sometimes create a buying opportunity.
Really? Negative rumors.
Occasionally, if a company is being overlooked or maybe unfairly criticized, but its underlying business is actually strong, it could be an undiscovered gem just waiting for the market to catch on.
Interesting. So sometimes being off the radar is actually a plus. Now let's flip that. What are the red flags? What kinds of companies should we generally steer clear of, according to Lynch?
He outlines several types to be wary of. First, the really hot stocks in a hot industry.
The ones everyone's talking about.
Exactly, where the intense enthusiasm and hype just inflate the stock valuations way beyond reality.
Mhm.
He mentions things like mobile homes back in the day, digital watches when they first came out, HMOs. And he uses the carpet industry's boom and bust as a classic example of this kind of speculative bubble.
So when your taxi driver starts giving you stock tips on a certain industry, maybe be cautious.
That's often a good contrarian indicator, yeah. What else should we watch out for?
He warns against what he brilliantly calls diversifications. Diversifications. Love that.
Isn't it great? These are just foolish, often overpriced acquisitions that are totally outside a company's core area of expertise. They usually end up destroying shareholder value instead of creating it.
Okay, stick to what, even for companies making acquisitions.
Pretty much. He also advises being really careful with whisper stocks or, the long shots. Companies with these fascinating, almost sci-fi stories.
But maybe not much actual substance.
Often, yeah. He lists tons of examples of companies where the exciting narrative, the sizzle, just wasn't backed up by the actual business results, the stake.
Right, the companies with those captivating, maybe too good to be true stories.
Mm-hmm.
And finally, just companies where the earnings don't support the stock price.
Exactly. That's fundamental. He uses Avon in the 1970s as an example. The stock price got way ahead of its actual earnings,
And
then it eventually came crashing down. He stresses that high price to earnings ratios, the PE ratio, basically how expensive the stock is relative to profits,
Right.
those high PEs require truly incredible sustained earnings growth to be justified. He mentions McDonald's and Polaroid as other examples of companies that got temporarily overpriced due to overly rosy expectations.
So at the end of the day, it always comes back to the fundamentals, especially a company's ability to actually make money. Lynch really hammers home the importance of earnings, doesn't he?
Oh, absolutely. For Lynch, a company's earnings are the number one driver of its stock price over the long term, period.
Is the engine.
It's the engine. He uses charts of companies like Dow Chemical and, again, Avon to show this really direct relationship. When earnings consistently go up, the stock price tends to follow, and, well, vice versa.
It's such a simple, critical connection, but maybe easy to forget when the market's buzzing about other things. Okay, so how do we actually get the facts? How do we do our own research? Lynch isn't a fan of just blindly trusting stockbrokers, is he?
No, definitely not. He strongly advises against solely relying on brokers. He really underscores the importance of doing your own homework, your own due diligence.
Where do we find the info?
He points out that there's a wealth of valuable information publicly available. You just have to look. Company prospectuses, quarterly reports, annual reports, they're all out there.
The stuff they mail you.
Sometimes, or online now. Plus, industry-specific trade publications can offer really insightful perspectives on the competitive landscape.
So the information exists if you're willing to dig a bit. What about actually talking to the companies?
Lynch encourages investors to reach out to a company's investor relations department. Don't just call blindly, though. Do your research first, then ask specific, informed questions based on what you've learned. He even suggests that visiting a company's headquarters, if it's feasible, can give you a really valuable first-hand feel for the place, the culture, the management's approach.
Like, check out the parking lot.
He actually mentions that. Observing things like a frugal approach to executive parking can offer subtle clues. Even asking a seemingly small question like, when was the last time an analyst visited, can be surprisingly informative. A long gap might signal an overlooked company.
Getting a sense of the vibe directly, he even mentioned his own chat with Lee Iacocca at Chrysler back in the day.
Yeah, those direct conversations with leadership, if you can get them, can really strengthen your conviction, assuming their vision aligns with your analysis, of course. It's about building a comprehensive picture from lots of different sources.
Okay, got it. Now let's dig into some specific financial metrics Lynch finds particularly important. He mentions the company's cash position. How important is that?
A significant cash pile on the balance sheet can be a very positive sign for Lynch. He highlights Ford and Boeing as examples of companies that historically maintained large cash reserves.
So lots of cash is good.
Generally, yeah. But he adds a crucial caveat. The per-share amount of cash needs to be meaningful relative to the actual stock price.
What do you mean?
Well, a company might have billions in cash, which sounds great. But if it also has billions of shares outstanding, the shares trading in the market, that cash per share might actually be pretty small. He uses Bristol-Myers as an example where the total cash looked impressive, but the per-share impact wasn't huge compared to the stock price.
So it's about the cash relative to the share price, not just the total amount.
Yeah.
Got it. What about book value? That's a metric a lot of people look at, assets minus liabilities.
Lynch finds book value often quite misleading. He argues it might not accurately reflect the true economic worth of a company's assets.
How so?
Well, he points out that Penn Central had a seemingly high book value right before it went bankrupt. Assets can be overvalued on the books, or substantial hidden debt can exist. It could even lead to a negative real book value.
So it's not always reliable.
Not on its own. However, he does note that sometimes there are hidden assets, maybe within subsidiaries like we saw with UAL or Delhaize, that are very valuable but aren't immediately obvious just from looking at the parent company's overall book value. And things like pension fund liabilities need to be factored into.
Okay, so book value needs careful interpretation, lots of context, and finally, let's talk growth rate. What's key there?
When it comes to growth rate, Lynch really zeroes in on earnings growth as the most critical factor for investors.
Back to earnings again.
Always back to earnings. He uses Philip Morris as an interesting example. They achieved significant earnings growth back then, not so much by selling more cigarettes.
Right. That market was shrinking.
Exactly. But through really effective cost management and, importantly, by strategically raising prices, they had pricing power.
So growth can come from different places, not just selling more stuff.
Precisely. Cost-cutting, price increases, new markets. But he also advises being skeptical of companies projecting extremely high growth rates, like 50, 100% year after year. Those are often unsustainable.
Look for steady, believable, profitable growth in the bottom line. Okay. Now, as we start to pull this together on identifying winners, Lynch lays out his 10 golden rules. A great summary, right?
Yeah, they really encapsulate his core philosophy. Let's see if I can remember them. Invest in what you know.
Rule 1.
Invest in good companies, obviously.
Right.
Adopt a long-term view. Understand that common stocks can make you a lot of money, but also lose it.
Sure. risk and reward.
Predicting the economy or the market's short-term moves is generally futile. Remember that long-term stock returns tend to beat bonds. Keep up with your companies, don't just buy and forget.
Active ownership.
Understand that investing in individual stocks isn't for everyone. Appreciate that average folks often get early exposure to great ideas in their daily lives.
The edge we talked about.
Having an edge helps. And finally, focus on what you understand, that one in the hand is worth 10 in the bush idea again.
That's a really powerful, actionable set of guidelines. Okay, so we've talked a lot about how to find stocks. The next huge question, and one I think many people struggle with, is when do we know it's time to sell?
Ah, the selling decision. Often harder than buying. Lynch offers specific guidance here, and it depends on the type of stock you own, going back to those categories.
Okay, so for the slow growers.
For slow growers, a sell trigger might be when the original reason you bought it doesn't apply anymore. For instance, if you bought it for the dividend and the company cuts or eliminates the dividend.
Makes sense. The story changed. What about the stalwarts, the steady eddies like P&G?
For stalwarts, you might consider selling when the stock price has gotten way ahead of the company's actual earnings growth rate, when it just looks too expensive based on its fundamentals.
Okay. When valuation gets stretched, what about the exciting fast growers?
With fast growers, you have to be much more vigilant. Look for signs that growth is starting to slow down significantly. Watch out for that diversification, foolish acquisitions outside their core business.
Right.
Or if key management people leave. And definitely a very high PE ratio compared to the company's realistic future growth prospects is a major sell signal.
So when that high growth engine starts to sputter, the price just gets too crazy. What about turnarounds and those asset plays?
The best time to sell a turnaround is often after the company has successfully turned things around, and maybe the stock is now seen differently by the market, reclassified.
So once the recovery is done.
Pretty much, yeah. For asset plays, you might often wait for some catalyst to unlock that hidden value. Maybe a corporate raider shows up or they sell off a division. Unless the company's debt load is so high that it's actively eating away at the value of those assets, then you might need to sell sooner.
Okay, so it's really about recognizing when your initial investment thesis is played out or when significant new risks pop up.
Right.
He also gives a list of more general sell signals, right? Applicable across the board.
Yes, a kind of checklist. Things like mixed or disappointing results from important new products, an unfavorable PE comparison to similar companies in the same industry, a noticeable lack of insider buying, increased vulnerability to an economic downturn, slowing growth combined with few options left for cutting costs.
Okay.
Potential labor problems like expiring union contracts with high demands, declining demand for the company's main products, maybe excessive spending on building brand new plants instead of upgrading existing ones, or just an inability to compete effectively with, say, foreign producers.
That's a really comprehensive list of potential warning signs. And he also warns against some common psychological traps when selling, doesn't he?
Right.
Like thinking, oh, it's already gone up so much it can't go higher, or maybe the opposite, it's only $3 a share. How much lower can it go?
Exactly. Don't let past price action dictate your future decisions. A $3 stock can still go to zero. And don't assume that a stock that's fallen will always come back. He uses RCA and Johns Manville as cautionary tales there.
Right. Some companies don't recover.
And be wary of that it's always darkest before the dawn, thinking in industries that are just in terminal decline. Sometimes it just gets darker. He used oil drilling rigs as an example.
So avoid letting hope or fear drive the selling decision. Face the business reality. Okay, before we wrap the main discussion, Lynch also flags some specific dangers to avoid in the broader investment world.
He specifically advises caution, especially for amateurs, with things like futures and options. The odds of long-term success there are just very, very low for most people.
Highly speculative.
Very. He also discusses how portfolio insurance strategies, which were popular for a while, could actually backfire spectacularly during sharp market crashes. And he notes the added complexities and risks brought in by things like leveraged buyouts, LBOs, high-yield junk bonds, and program trading.
So generally stick to the core principles of investing in understandable companies and maybe steer clear of the really complex, potentially dangerous financial instruments.
That's generally his advice for the individual investor, yes.
Okay. In his concluding thoughts, Lynch really brings it back to the long-term view and understanding investor psychology, doesn't he?
He does.
Yeah.
He reiterates that individual investors often have real advantages over the big institutions. Why? because institutions are frequently obsessed with short-term performance quarter to quarter,
Right.
and they can be more easily spooked into selling during downturns just because everyone else is. Individuals can afford to be more patient.
Less pressure.
Less pressure.
Okay.
He also emphasizes that the costs of frequent trading commissions, taxes, really add up and rarely lead to better long-term results.
All that churning hurts.
It does. He encourages maintaining a basic fundamental faith in human ingenuity, capitalism, the country's long-term future prosperity. Adopt that long-term perspective. Be willing to add to your winners over time. Don't pull out the flowers and water the weeds, as he says.
Love that analogy.
And finally, he offers very pragmatic advice.
Yeah.
If you honestly don't think you have the time, the skill, or the inclination to properly analyze individual stocks, then investing in a good, well-diversified mutual fund is a perfectly sensible alternative. Nothing wrong with that.
Point.
And he concludes by reminding us, look, there will always be something to worry about in the market. Always. But it's absolutely crucial not to let those short-term fears dictate your long-term investment strategy.
Fantastic summary. So The Learner, as you can clearly see, Peter Lynch offers just a ton of practical, really down-to-earth advice.
Yeah, very common sense based.
Exactly. Emphasizing that your own everyday observations, your common sense, these can be incredibly powerful tools in investing. It's about looking past the daily market noise, truly understanding the businesses behind the ticker symbols, and just maintaining that patient long-term perspective.
We really hope this deep dive has given you some valuable aha moments.
Yeah.
Maybe a clearer framework for how to approach your own investment journey.
Yep.
Remember, this is just the beginning, right? Start thinking about the companies, the industries you interact with every day, which ones might have that hidden, untapped potential, what seemingly dull businesses around you are actually doing really well.
Yeah, keep those eyes open. And for your continued exploration, maybe mull this over. If you were to pick just one company you're a regular customer of, but whose stock you don't currently own,
Okay.
what would be the first 3 things you want to dig into about its actual business, its fundamentals, its future prospects, based on what we've talked about today?
That's a great exercise.
Keep that curiosity alive, the learner, and happy